Hey, good evening, everybody. I just want to do a mic check and also a visual check and make sure everybody can see the chart and also can hear me okay. Okay, great, Keith. Thank you. Thank you, Christian. Thanks much. Okay, great. We have a very small crowd today. Um, I didn't heavily promote the webinar, but it doesn't make any difference to me. I mean, it's as important to me if I talk to a small crowd. Hey, good evening. It's important to me as if I talk to a small crowd as if I talk to a large one. And really, what I wanted to do this evening, and I really appreciate everyone who's giving me their time on a Sunday, is to define the components of our system that I believe provide it with such great predictive value in terms of taking a successful trade, and also talk about some of the things that are used out there for trading, which I believe have no predictive value, and I think that are really best kicked to the curb. Um, and before I start, what I wanted to talk about first was that of Fibonacci. And it's good that I have a small group because so if you have any questions, you can just put them in, and I will wait till the end to answer them, but um, I can get to every question. Now, the thing about Fibonacci is I don't exactly remember when Fibonacci described the Fibonacci progression, which ultimately went on to become a Fibonacci transformation. I think it was in the 1700s. Um, but how it got applied to the stock market and the movement of financial instruments is really beyond me. I don't think anybody knows who first decided that Fibonacci described the support and resistance levels or um, extensions or retracements in the market. And I don't think anyone wants to take credit or discredit for that, except that there are a lot of ardent Fibonacci admirers. And what we did was, now I think it's important to know that Fibonacci numbers and Fibonacci transformations, although they do describe some things that take place in nature, like the spirals on a pine cone and the number of edges on a snowflake, and some interesting things. There's absolutely no mathematical hard application for Fibonacci. It doesn't describe anything. It doesn't describe the motion of particles on a macro or micro level. Its utility in, say, in the use of a production of a semiconductor, or the way that electrons or protons move, uh, are zero. So it really is nothing more than a mathematical curiosity that has no practical value. And what we did here is we looked at a year retrospectively of Fibonacci data, looking at whether or not it was predictive of a price turn. And we found that there's very little predictive value in looking at Fibonacci. So I really I'm sometimes stupefied about people who put out, the secrets of Fibonacci myths revealed, and if you learn how to be a fib trader, you'll make money. Because what we have done mathematically, and if I had the time, I would actually publish this material in a paper. We've shown mathematically that Fibonacci in no way adds to the positive predictive value of a trading entry. It doesn't adequately predict a turn. It does not adequately predict support and resistance. And to me, it is just a curiosity and a myth. And the same with Gann theory. I mean, Gann theory is much more elegant and was actually created to describe stock market movement. But I have looked and looked and looked for any type of Gann theory application in the movement of the market, and I for the life of me cannot find it. So I'm very, very. Whoops, let me just drop this. It's way too high here. I'm very, very down on Fibonacci and Gann theory simply because I can't see how it works. And then I'm trying to think, it was Fibonacci, and then there was Elliott wave. Now, I do think that Elliott did have some things that I think are useful to describe market movement, and I'll show you later on exactly how we incorporate Elliott wave theory into our trading methodology. And if you constrain to a great degree the principles of Elliott wave theory, I think you can apply them in a rational way to trading. And they do, in a very, very circumscribed way, do describe the manner in which financial instruments move. But you have to be very, very careful. There are software programs that will take entries based purely on Elliott wave theory, and there's one out there called MT Predictor, which I've looked at. It's been around a long time, and they're the first people to tell you that they basically run 50-50. About 50% of their trades are winners, 50% of their trades are unsuccessful. What they do, though, in making a profit is based on Elliott wave theory. They really, really look to let their runners run. And when I mean run, I mean go a long, long, long way. So that's how they look to make profit. They look to have their runners be significantly bigger than their losers. But they run a 50-50 win-loss ratio. So everything that we have on the platform is done for mathematical reasons. I mean, we know that they add to the predictive value of a trade and that they help us with our entries. And what I want to do is start from the basics and take a lot of stuff out of the platform. I might have taken out the bias, and I want to put that in. That's here. Let's see where the heck it went. Oh, okay, I'm sorry. It's not the bias I want. It's the RL trend. And really, what I'm really doing in a roundabout way, in my humble opinion, is really to teach you how to be successful day traders and to show you what to look for in terms of defining your trades. Now, if you just look at the candles, a lot of times I refer to price action. And when I refer to price action, I refer simply to the way that price moves. Now, we define price in terms via the use of 8 range candles. It doesn't make, I mean, to me, it makes a big difference. But you don't have to use range bars. Although I really like them, you don't have to use candles. You can use an open, high, low, close bar. I'll show you that. But to me, this really doesn't define market structure. And that's the second component of what we use. If you just want to look at price action, this defines it really well for us. But what we want to do is look at price action, and we want to look at market structure. So let's go back to the range, and let's go back to the candles. Let me just make them thicker. Now, what does price action alone tell us when we incorporate? Well, I was giving it a break at 50-50 sigma. I know it has a pretty poor win-loss ratio. I have to tell you, I looked at it many, many years ago and did a really, really detailed analysis of it. And its win-loss ratio is really quite poor, just based on Elliott wave theory. So what we're looking at, if we just let's for a minute pretend that we're not looking at the 50 and the modified 15, and we're just looking at what price is telling us. And now, in my opinion, it isn't giving us a whole lot of information. I wanted to show something where I feel you get some really reliable information just by looking at price. And I'll find it somewhere here. At least this is one of the things that you can look for. But if you're going to use price to do this, you're going to have to call tops and you're going to have to call bottoms. And here's an example. And this is really all based on this is essentially Fibonacci retracement, which I'm not a big fan of, as I had mentioned. Now here's a move. This is a price goes up. It then retraces at least 70% of the move. And I would say, just by estimate, without using the Fibonacci tool, this is a 70% retracement of this move to the upside. And the reversal here comes with an engulfing candle. And what you're going to do is you're going to go long right here, simply based on price action. You're not using market structure. You're not using the fact that it's going into the modified 15. You're not looking at the fact that you're taking a counter trend trade. That's all market structure. Right now, we're just looking at price action. And if we base this entry simply on price action alone, that would be a valid long. Anytime you get a 70% retracement of a move to the upside or a move to the downside that terminates at an area of support or resistance, and it's terminated with an engulfing candle that shows the enthusiasm or the strength of buyers to the upside, you can take this move as a reversal. You can't do it unless the candle engulfs. So this is an example of a pure price action move, not based on market structure, not based on market structure. But we don't trade this way, because I don't believe. Listen, there's a lot of people who really, really believe that price action gives you all the information that you require to take a trade. But we don't believe that way. We believe that price action and market structure combined are what really gives us the trades. Now, as part, and I'm really giving you right line dogma. We only go short below the 50. Now, below the 50, we believe that the bears are in control. And you always hear the technical analysts talk about, well, the market's broken its 200-day moving average or 200-period moving average. That's really bearish for the instrument, and we now look for it to fall. Well, we feel the same way, actually. When price falls below the 50, we believe there's been a technical break of support, and we're only going to take the market to the downside. When price is above the 50, we're only going to go long. We believe there's been now there's been a technical change. Now the stock is bullish. So this is the way we define our trend. We're only going to go long, and we're only going to go short. We're not going to try to call a bottom. We're not going to try to call a top. Our 50 is our line of demarcation that tells us who's in control of the instrument. The institutional guys here are in control to the long side. The institutional traders here are in control to the short side. Now you can see that that's going to reverse. And you can get some nice moves to the upside, like this, but we don't trade them. And part of our dogma is that we have to remain specific. We have to set up very defined, very dogmatic principles by which we trade, and we can't deviate from that. And if we want to try to get in on every 5 or 6 or 7 candle move, we're going to pull in a ton of losers. And that's the other thing that other platforms do not define for you. And I want to tell you what I can't spell. Is sensitivity. See, I told you I can't. Now, sensitivity is true positives and these are really important numbers over true positives plus false positives. Now, if sensitivity was perfect, the false positives would be 0, and true positives over true positives would be 100%. But as the number of false positives increases, sensitivity begins to drop. Now, the more trades that you chase, the higher you try to push sensitivity, the more false positives you're going to pull into a trade. Now that's a mathematical axiom. The other one is specificity. And that's the number of true negatives. That's what we want to find out. We're not interested in all the true positives. We know that they're going to be, well, we're interested in them, but we know we can't get all of them. What we want to do is have our tools filter out the false negatives and get us into the true, and define the true negatives. That is the trades that are not going to work. That's a true negative. And it's true negative. Obviously, this is not built to do this. But it's true negatives. Over true negatives plus false negatives. And there it is. So what you're really doing here is you're deciding whether or not you want to trade with a high degree of sensitivity, that is, try to get in on every big market move, or in other words, try to define every true positive, or trade with a high degree of specificity. You want to define every losing trade, which is a true negative. The key to trading is to trade with specificity. Try to define every true negative trade. And I want you to understand the basic math behind trading, because this is something that nobody else is ever going to teach you. They're going to slap up a bunch of software for you, but they're not going to define how it's been developed, the mathematical principles behind which it was developed, and how it performs. I've asked 1 million people the sensitivity and specificity of their indicators, and nobody can ever give me an answer. But these are key numbers. If you don't know these, you know nothing about the trading platform that you're trying to sell or you're trying to use. Now, the other thing that's really important, and I'm going to take this out because I think you understand it, is the predictive value. A value of a trade, and that is the sensitivity. And I just want you to know this is not an exercise in nonsense. This is very, very important. It's sensitivity. I'm not going to put the line in, over specificity. And the thing that's really important that I can't just do really well here, it's multiplied. And this is the numerator and this is the denominator. It's multiplied by prevalence. Now here's the key to, now you want the positive predictive value of a trade to be very, very high. That's the key. When you take a trade, you want that positive predictive value to be exceedingly high. And you see that sensitivity and specificity are related to each other. They're proportional to each other, but they're multiplied. The multiplier is prevalence. And let me show you how prevalence factors in. If your software, what is the prevalence of a trending market in CHOP? The prevalence of getting a good trade, or getting a trade that has a trend in CHOP is close to 0. So you have to define clearly with your software what is CHOP and what isn't CHOP, because you could get a signal to go long or a signal to go short in CHOP, but because of the fact that the prevalence of a trend trade being successful in CHOP is low, and sensitivity over specificity is multiplied by prevalence, if the prevalence is 0.2, it's going to drop the positive predictive value of your trade way down. If the prevalence is 0.9, it's going to take the sensitivity over specificity times 0.9 and give you a positive predictive value that may be 85%, 90%. So what we want to do is we want to trade with a tremendous degree of specificity. We want to bring that numerator up, the denominator up as high as possible. And we want to have a prevalence as big as possible. So when we multiply these together, we get a positive predictive value that's as big as possible. So what the software is it's really important to do. Now this is all theory, but that's our goal, and that's where we want to get. So that's why we need not only price action, we need market structure. We can't determine the positive predictive value of a trade unless we can determine prevalence. And the only way we can determine prevalence is to define a trend. Now, there's all kinds of ways to define a trend. And I just want to put this indicator in really, really quickly. This is not a right line. This is just a SMA. It's an SMA 15. And that's just this orange line. Now you can define a trend to be present when the 50 and your simple 15-period moving average is to the downside. But you see that the simple moving average is very smooth. And tends to increase sensitivity and decrease specificity. The exponential moving average is even worse. Now I'm asking this question, and I don't expect anyone to answer me. But why does the exponential moving average hug price tighter than the simple? And the reason it does is because the exponential takes into account the close of the last few candles much more heavily than it does if it's a 15 period. It's going to take the earlier periods into account much more. It's going to make those much more important than the ones that are farther out. So it's going to hug price action even closer. But you can see how poorly they are for defining chop. They're almost always in a downtrend, even when price action is not. So what we developed, I'm going to take them out, is a modified 15. It's an amalgam of 3 lines. And those of you who were members early on would remember that in a fast market, the line would splay, almost it would unravel like a cord. And you could see all 3 of the lines kind of stick out. You know, when we got Leo on board, and he's such an expert coder, he changed all that and modified all the indicators, took out all of the errors in coding and things. Now the line is just really perfect. But what we look for, the whole point, and this I think is one of our most powerful indicators, is that when the line is yellow, we define this as chop. And we know that the prevalence of getting a move during this yellow modified 15 is low. And we just take that as a truth. And we never trade during a low prevalence period of a trend. So in the modified 15, now sometimes price will move off the yellow modified 15 and make a significant lurch to the upside or lurch to the downside. These are simply moves that we have agreed that we're going to let go because we're trading with specificity, not sensitivity, and we're looking for periods where trends are very prevalent. Now I can see just one beautiful move here. I don't want to jump ahead, but I see it. There's your sideways price. And the people that are in the trading room know that I look for this. Price action moving sideways. And through this whole period of sideways action, look what's happening to the modified 15. It continues to fall. And as soon as price hits resistance, down it goes. Here's your perfect short. If you try to short the market here, or here, you're going to get stopped out by this candle. You just wait for price to drift sideways into the 15, and the 15 you can see continues to move to the downside. That's price action and market structure at its best, and that's how we leverage it. Clearly, the 50 is to the downside. Clearly, the 15 is to the downside. In fact, the 15, it's amazing right here how where price is totally sideways. The market's not making higher highs. It's not making lower lows. It's simply range bound in this very, very tight channel. But the modified 15 is telling us something, because boy, is that thing heading down hard. So when you see that, you kind of sit like a vulture and you wait. And that's the way to leverage. And what we're doing is we're leveraging prevalence. We know that we're in a strong downtrend. So the likelihood of the market trending is high, and we're looking at market structure, sideways action into resistance and then down. And that's a great example of trading with a low degree of sensitivity, or a decent degree of sensitivity, but we wait for the trend to develop. And the key thing here is, even on this trade, you don't see these, we wait for the 15 to cross the 50 to the downside. That's a very specific trade. We're waiting for all of the parameters that we define to give us a trade with a high positive predictive value, tremendous degree of specificity, 50's down, 15's down, price moves laterally, it consolidates right into the 15, and then we know a trend is very likely to happen. That's trading with a tremendous degree of specificity, and we know that the prevalence of a trade coming up, this is going to be a good trade because we're in a strong downtrend. But let's say that we've decided that this is just not enough, that we want to increase the predictive value of our trades even more than this. And let me tell you, this isn't bad right here. And if you just traded the 50 and the 15 and waited for consolidation, you wouldn't do bad. But there's still some things that are a problem. And one of them is this. The one thing that we do not want to do is trade a single time frame. It's really, really difficult to do. We want to make sure that if we're taking a short trade, that we're trading with the long-term trend. And that's known as fractal analysis. So fractal analysis has your chart assimilating data from multiple time frames. And that really, really pushes up the positive predictive value of a trade exceedingly high. So let's add in our multi-time frame analysis. Now remember, we are not looking at indicators. We don't have stochastic, we don't have momentum, we don't have a MACD. We are purely looking at price action and market structure, nothing else. Now here is our bias. Now this tells us what's going on multiple time frames. And I think that bias, for all the people that trade the right line system, is one of the most confusing. Now this dark pink, and I just pulled this out of nowhere. Believe me, I didn't preset this. It tells you that this short trade here even has a greater positive predictive value, because both up bias and down bias are defined by 3 colors. And it's very, very important, if you trade the right line system, to understand in a flash what those 3 colors are telling you. Now, I'm recording this. It's going to be posted. If you want to review it, you can. I do have webinars about it. But when you have this color, dark pink, it means that you have this happening on 2 higher time frames. To the downside, all support is broken. And that's a great thing, to not have to worry about support holding up your trade to the downside. You're only going to get that on that dark pink color. You also are going to have the 15, the modified 15, down, and the 50 down. Now that's a lot. Now it's also a given. Now I just want to say one other thing. It's very important, but I didn't put it in because it's almost a given. On all the time frames, price is below the 50, and not only is the 15 down, but it's also below the 50. So it's it's assessing multiple parameters on 2 higher time frames on this dark color. It's telling you that price is below the 50, all support is broken, the 15 is broken through the 50, and the 15 is heading down, and the 50 is heading down. Now, you can put up the two higher time frames, the 13 range. We use the fib numbers, 13 range, and we use a 21 range. And you can have all three of those charts side by side to make that same assessment that this is doing for you right here. And this is really invaluable. And the key to making bias so important is that price action on the chart doesn't affect the color. It's the color affecting price action. So you can see the tremendous proclivity of price to fall when the color is pink. It's because your higher time frames are falling. It's because the 15 and the 50 are heading down on your higher time frames. It's your higher time frames. You've got the 15 below the 50. And unless there's a radical reversal in direction on a great entry like this, you're going to get a successful trade. And what you do is as price moves through this area of pink, you look for another successful entry. Unfortunately, it doesn't happen. You move into yellow, which is chop. We're going to talk about being far off support or resistance later. Yellow again, and we just can't get the trade in this period. We just can't get an entry. But we know in no way are we going to take a long trade. We're just looking for short trades. Now, the same equivalent of this color to the long side is this color. The green. It's just everything is reversed. Price is above the 50. All resistance to the upside is broken. The 15 is crossed above the 50, and the 15 and the 50 are to the upside. So we know that the predictive value of a long trade on green bias here, or the dark pink bias for a short, really is very high. And we do get a nice trade. We get a move to the upside. We're just basing this on market structure because that's the only thing we've done so far. We get a move to the upside. We get a structural retracement. Whoops, wrong button. And then a continuation long with a very high predictive value of this market continuing to the upside because of that. And then we don't get another entry on this dark green color. Now, if you trade the right line system and you just want to trade the dark green color or the dark pink color, you're going to have a very high likelihood of getting a winner. Now, I'm going to add other parameters to try to push your predictive value even higher. But right now, we can see what we want for taking a long trade. We want the 15 up, the 50 up. We want the 15 to have crossed the 50 to the upside. And the dark green tells us that we have the same setup here on two higher time frames. And the dark pink tells us that we have the same setup to the downside on our two higher time frames. Now we have two other up colors. This is the weakest to the upside, and this is the weakest to the downside. It's kind of like the flat blue and the lighter pink. Now on these trades, on this background, what you have, and I want to type it in because this is important. And let me move this down because really what we're doing here is we're looking for a short trade because bias is to the downside. is what we have here is we have all support broken. But we have no trend. The 15 is flat and the 50 is flat. So although we've broken support to the downside on this light color here and on this kind of flat blue here, where we've broken all resistance to the upside, we don't have the 15 and the 50 with us. Now the key is really the 15. And if we don't have the 15 with us, that's really where you might want to stand aside. Now, you know, bias tells you you're never going to take a short trade here, because here you've broken all resistance to the upside, so you have 2 tons of support. And you know you're not taking a long trade here. You have all support broken to the downside and a ton of resistance to break to the upside. So bias tells you either you're going to take a trade or you're going to lay off a long trade. Now, we already know that we're not taking a long trade because we're below the 50, and that's our cutoff for a trade. But we've got further validation of staying off of a long trade, because here support's broken and here is resistance is broken in a higher time frame trendless market. Now, if we make an assessment of a higher time frame trendless market where all support and resistance are broken, then we also have to make an assessment of a trendless market, of a trending market. And we've really revised these colors over and over again. Now, on this color, what you have is you have resistance to the upside that still needs to be broken. And the 15 can be below the 50. But the 15 is up, the 50 is up, and the key is price is above the 50. We never break that rule. We are never going to go long unless price is above the 50. So on this color, price is above the 50, the 15's up, the 50's up, but the 15 hasn't crossed the 50 yet. So you see what happens as price continues to move? The 15 eventually crosses the 50, breaks resistance to the upside, and the color changes. So you go from a flat market where all resistance to the upside is broken, but it's trendless. Then the higher time frames, the 15 starts to the upside, but it's below the 50. So this is a little bit of a riskier trade, and you also know that you have resistance to the upside to break. But let me tell you, that's a good color to trade if on your trading chart you have a really, really nice entry. And then finally you break out into the color that you really, really kind of salivate for. There's the color. We've got the 15 above the 50. You've got all resistance to the upside broken, and bam, that's your gray color. But you can definitely trade this color. You can trade this color with caution. Listen, the purpose of the platform is to define risk. Everything that we put on here has a purpose, and it's really all based on your risk tolerance. You can make your own trading plan. You can say, I'm only going to trade the green, and I'm only going to take those trades because they have the highest predictive value. That means I'm sorry, Sigma, can you tell me that again? Sigma writes, your description isn't what the chart is showing. Can you just tell me what you mean? Okay, I'm not sure. I'm not sure exactly what you mean. Are you looking at higher time frames right now, or are you looking at the time our trading time frame? I'm going to open the chat so everybody can see what you're typing. Chat's open now, so everyone can see exactly what you're asking. The text is showing price above the 50. The text says price is below. Oh no, that's because I just cut and pasted it. That's all. I have to change it. I just cut and pasted from the other color. See here, price is above the 50. This should be all resistance is broken. 15 up. And this above the 50 and the 50 up. That's all. I just cut and pasted it. And I didn't switch it. So let's take a look at the same thing to the downside. Now here we know all support is broken to the downside, but we know that we're in a trendless higher time frame market. The 15 isn't down with us on the higher time frames. Here we lose all bias. And usually when you lose all bias, it may mean that the 15 is above the 50, but this is the riskiest place to trade. And then let's go to here's where you have on the higher time frames. You don't see this often. This is where you have the 15 heading down. You have the 50 heading down. But you've got support that still has to be broken, and the 15 has not crossed the 50 on the higher time frames. So you're in a trending market. It's trending to the downside, but it's got work to do. And you can see the 15 never crossed the 50 on the higher time frames, and the trade reversed and went right back to the upside. This was not a successful short setup, at least with bias, unless you took this trade, which conceivably you could have, and then down. But what I'm trying to do is not so much right now point out trades, is simply define risk. So that when you take a look at the chart and you define your own trading plan, listen, there's some people who are going to trade with it and don't mind taking additional risk. I mean, take a look at this trade right here. Here's a move to the downside, a move to the upside, a perfect setup. It occurs on a green 50 with no bias. So we know that the higher time frames are all a mess. And it goes down for a significant run. That's the problem. That's one of the downsides of trading with specificity. This is not a trade that I probably would have taken. I don't like to trade without bias. I like to trade with it. And that's when you're going to have to let really, really nice market setups, structural setups go. It all depends on your own risk tolerance. The one thing that a platform cannot define is whether or not a trade is going to be successful or unsuccessful with any absolute value. All it can do is define a percentage. It can define a positive predictive value in percent. And if you trade with a significant amount of specificity, this is a trade you're going to have to let go. And the killer here is you get nice sideways movement here too. This is a great structural trade. It just doesn't correspond to the higher time frames. The problem is that there's play. And sometimes you're going to get a good move in between periods of bias. It all depends how you decide to trade. My bent is to stay as conservative as possible. Now, let's add a little bit more. Now we're going to add the ABC indicator. Let's find a nice ABC trade. We get beautiful ABCs on crude. And here's a nice ABC right here. The move to the downside, up, and the move to the continuation down. Now, the thing is, we've got a yellow 50. We can accept it. The 50 is crossed to the downside, and because of background bias, we know that we have all resistance to the downside broken. We know we're not trading we know we do not have a 15 and a 50 on the higher time frames necessarily moving in sync. But this is a good trade, and the reason it's so successful is that we've caught all these traders in the counter trend move. They're all looking to go long. They're engulfed to the short side. So it's propelled down by two forces: the addition of new sellers and the stopping out of all these people in this failed counter trend move. And the C entry is really a powerful entry, and that's an 11 tick trade. Let me just reset the bias. Yeah, because I didn't think that was right. And see, here's another terrific trade. Now, this is not a C candle, and I just want to stick with the C's right now. Here's a great C. Here's one. Gives you one target. Eventually, actually, it's going to give you more. Well, it's going to give you one. Then, there's your second C, and up you go. So you get two great trades simply out of trading the C's. And let me reset bias again, because it's impossible for me to move. Here we go. So that's what happens with a fractal indicator. The fractals are really handled poorly by NinjaTrader in retrospective analysis, and I got to keep reloading. So you see, you've got the best color, you've got the C candles. We know we've got the 15 and the 50 to the upside on multiple higher time frames. The C is our strongest entry. Here we got this is a 7-tick move. It's 1 tick away from closing an 8-tick candle, and this is a very, very nice move to the upside. You can get this every day. You're going to be a profitable trader. That's a 23-tick trade. That's all you need to make your day on 3 contracts. That's going to get you between $300 and $400 a day. You see, I've got to reload it again simply because of how badly Ninja handles the fractal indicators. And here's a good C to the downside. Now, I don't want to take up too much time, and I want to get, and there's the C. Now, I want to get to, because there's a lot more. It's not nitpicky, because everything is important. I'm going to add the pivots just to show that we don't usually trade into unbroken pivots. Sometimes we do. That's not a hard and fast rule, but what we did was we never make a rule unless we've tested it. We did a year of retrospective analysis just looking at C candle entries, not trading into unbroken pivots, and in other words, avoiding an intact pivot and not avoiding an intact pivot. And the net equity at the end of a 365-day period was much higher if we stayed away from trading into intact pivots. But the one thing the analysis didn't do was look and see how many times the pivot had been hit. So let's say, and it didn't look at the size of the pivot. If you have a small swing pivot like here, which is just walked through, versus this huge pivot here, which turned the market. I mean, a C candle tried to get through it and couldn't make it. Another candle tried to get through and couldn't make it. Another tried to get through and couldn't make it. And you might think on the fourth try, you're going to get through here. Doesn't work. And it actually turns the market down. And if you kept taking these trades, you're in for 1, 2, 3 losers and a crushing day. So looking at the size of the pivot, and in general, the number of the times a pivot has been hit, this is proving me wrong, obviously, because this kept getting hit and getting turned around. But trading into unbroken pivots will decrease the predictive value of your trade. So it's very, very important. And it's up to you whether, here's another one. There's a C candle. Remember, the pivot's an area. On the best background bias, hits the pivot, reverses. So you just have to be very careful. Here's a great trade to the downside that goes right through the pivot. Pivots really, to me, are an enigma. And, we've tried to determine mathematically if there's any way we can determine whether they're going to break or not, and we can't. And I'll just tell you one other mathematical thing that we found that I really can't understand. And I'll show it to you real quickly. It doesn't make any sense to me, and I don't understand why. And it makes me feel like nobody understands really the true movement of the market. Now remember, the 50 defines momentum. The harder to the downside a trade is, the harder, the stronger the momentum to the downside. So let's say, and this doesn't happen too often, but we used to have a trade, and it used to be a bounce off the 50 to the downside. And what we looked at, let me find one. It's always hard to find one when you're looking for one. All right, well, here's isn't a bad one. You move to the upside, you hit the 50, you're not as tight as you'd like to be, and it bounces right back down again. Now, this is really a trend trade, because here's the movement down, here's the retracement, and then the movement to the downside. Now, it seems intuitive to me that the stronger the 50 is to the downside, obviously the stronger the momentum to the downside, the higher probability the trade would take of bouncing off the 50 and heading to the downside. And we looked at this, and we found that there's absolutely no correlation between the slope of the 50 and whether or not you're going to get a bounce or you're going to get a break. And that's something I cannot explain. It doesn't make sense to me. And it means like there's something inherent in market movement that we just don't have a handle on yet. But here's the thing. If I could define a slope whereby, say, 80% of our trades were successful, I could be a billionaire. Because that would give me one single number to define whether or not to take a bounce off the 50 or to let it go. And I don't think the market's going to be that kind to us. And you know what it is? We look at one variable, and it's probably a multivariable equation. There are probably more than one variables determining whether or not you get a bounce or not. So aside from that trivia, I put in the pivots, and now let's take a look at a couple more things without my going too long here. Here's the consolidation indicator. Now, remember I told you how important it is. I'm going to load a template, and then I'm going to take out the junk that I don't want. Because I have everything on the template. I have everything perfect. Here's my 8-range crude. There's my template. And I'm just going to take out a lot of stuff here. The bias we want to keep in. ABC we want to keep in. The trend, the pivots. Take out the chase. Momentum. 3-line. Quants. Just for now. Okay. So now what we did is we put in an indicator that when the fourth candle closes, it defines consolidation for us. Now I have this set for an audible alert. Because here's what you have to ask yourself every time the market, and you see the bias again in a dead market, has to be constantly reset. Is ask yourself, when a market starts to consolidate, which way is it ultimately going to break? Is it going to break to the upside or to the downside? And here's a great example. Now, these red and blue lines are not put in here retrospectively. After 1, 2, 3, 4 candles, you're going to see it flash on the fourth candle and then print. And it's going to stay. And you're going to wait for the market to move sideways in an indicator. It's in an indicator analysis with an audible alert that's going to tell you. Now, if you took the short here, you wouldn't have been stopped out. That's not a bad place to take it. If you took the short here, you got yourself a really nice trade to the downside. And we can look at consolidation is just a terrific structural component to the market that when you see it, the background bias, the 15 and the 50 are almost always going to tell you the direction that you're going to break out of consolidation. Let me find another nice period of consolidation here. See, here's a great period of consolidation right here. Unfortunately, can't take it because this candle occurs on a yellow 15. And that's just one of the problems with trading with specificity. There's some good setups you just can't take, but here's a setup you do take. There's the retracement, and there's the move to the downside. So you can't get the move out of consolidation. You wait till the market starts to trend. It retraces, and you got a great downside move. That's a 35 or 40 tick move to the downside. And there's your consolidation. You get a move to the upside. The market starts to consolidate laterally, like this. There's your entry, and up you go out of consolidation. So I have that set to an audible alert on all my charts to take a trade out of consolidation. And I took some great trades last week out of consolidation. Let me see if they're still on the chart. You know what? You know why they're not here? Because I kept reloading the template. And when you reload the template, it takes out your trades from last week. But I had some great trades out of consolidation. Now here's the last thing I'm going to show you. There's still more nuance to it. All things that push the predictive value of the trade in your direction, and that is our quantitative analysis lines. This is really kind of, honestly, the pièce de résistance of our trading. Now this is our quant line. Now here's the thing about the quant line. Now I just have to reload here. The quant line is making an assessment of 3 correlative markets. And you know what? I'm going to show you a different quant line. Let me load the template for the Russell. And I think before it's going to work, I should probably change the chart to the Russell too. It might help a little bit. All right, here's the Russell. Now we have dual quants on the Russell. Now, there are 5 correlative markets on the Russell. In other words, these correlative markets are either going to move in the same direction as the Russell or in a counter-trend direction on the Russell. And they do it with a correlation coefficient of 0.7 or greater. So 70% of the time, the markets will either move with the Russell or against it, and we already know which direction. And when they're all moving and they're all aligned in the proper direction, because we have 5 markets, we had to use 2 lines. Now, on a dual green quant, as we call it, take a look at this trade. Now, talk about trying to minimize risk. You've got consolidation, which is a great structural signal. You're taking the trade right off support, right here. And on top of it, the 5 correlative markets that are assessing whether or not, or that are minimizing risk, that should move either with the Russell or against it, they're all moving to the upside. I would honestly say that the predictive value of a trade like this is 90% or greater. You have so much information here telling you that this is going to be a successful long trade. And if you simply wait for these setups, they're going to go. Now let's take a look at the Russell. Look at this trade to the downside. Now, I haven't talked about order flow and momentum, but when the candle's circled in red, that means you have order flow and momentum on multiple time frames. We always do a multiple time frame analysis. I do not believe that unilateral or uni-time frame analysis has any value. Here's the correlative markets are all to the downside. I mean, honestly, this is a trade you can, as I call it, you can back up the truck. There's no way this trade isn't going to run 41 ticks for you. Now, how many of these trades do you need in a day? So here's what you're looking for. If you want to minimize risk, here's your best down color. 15 and 50 are down on the higher time frames. 15's crossed the 50. 15 has crossed the 50 to the downside on the higher time frames. All support is broken. You've got a free move to the downside. Whoops. Where did I put that trade? Here it is. You've got a free move to the downside. You've got multi-time frame order flow and momentum to the downside. You've got a C candle, which is our most powerful entry. You've got order flow and momentum, multi-time frame analysis. I haven't talked about that X. The X is analyzing momentum on 4 time frames. We threw in an extra one. I mean, this is a kind of trade, if you wait for these trades, you might as well. If you get a loser here, you need some Prozac, because this is very, very rarely going to mature into a loser. And that's just what you're looking for. And you understand that if you trade anything else, there's another one. And I like this trade a lot. Move to the downside. This is the second strongest bias. You've got dual quant confirmation right here. I love the dual quants. This is multi-time. All 5 markets are being assessed at a different speed. But you've got 5 markets assessing direction. This isn't a gigantic trade, but you know what? I'll take a 17-tick trade any day of the week. And risk here is minimal. Minimal. You don't have the best down color, you have the second best. And with the dual quants thrown in, this is just a terrific trade to the downside. Now, this is a trade you just can't grab. And you're going to see those. Let's see here. Now, hold on a sec. Here's another one right here. And down. Now you could this is a much more aggressive trade. I remember this trade. I didn't take it. It was into an unbroken pivot. It's far off resistance. You could have taken this trade, but I didn't want to take it because the quant line was yellow. And you can take the minor quant line red. They're dual quants. This is the major. This is the minor. You wait till they all roll, and down you go. And this is a very, very, very nice trade. You just have to wait for the alignment. And if you have patience and discipline, you have 26 ticks. Really with no muss, almost no heat on the trade. So that's really about it. I mean, there's other things, obviously. I mean, this is volume. We have a very, very nice volume counter. This gives you the number of contracts per minute. There are other factors involved. This isn't just the only factor. There's smaller things that we have on the platform to help decrease risk even more. But I want you to see what our goal is. Our goal is to define risk for you, and our goal is to provide you with multi-time frame analysis without having to have the cumbersome difficulty of having multiple charts set up and you sitting there with your crosshair waiting to see if everything's going to align. This does it all for you. Everything does an analysis of multiple time frames. Nothing here. It does an analysis of only your trading chart. Nothing. So everything that you see here is multi-time frame based. So that's really about it. It was a very small group, but I really enjoyed giving you this webinar because I really want to explain how we trade and where we've come. I mean, this is a platform that's evolved over the course of many years. And my idea to add the quantitative, and the reason we call it a quant analysis, is that each market, there's 5 markets, they're not all equally weighted. You have to quantify each market. Some markets have a very high quantitative value. They correlate very closely with the correlation coefficient closer to 0.8 or 0.9. They have hierarchy. Some of the markets, although they got to be above 0.7, just hug 0.7. Their quantitative component in these lines is less. So it took us a long time to develop them. But now we have them on the Russell, the NASDAQ, the Dow, the E-mini, crude, gold, the 6E, and what our ultimate goal, and I'll just tell you this really quickly and then I'm going to finish, is we're going to make them for big sections of the market. We're going to make them for things like, there'll be one section where you're going to have quant lines for crude oil, heating oil, and natural gas. You're going to have another section where you're going to have quant lines for gold, silver, and palladium. You're going to have another section where you're going to have quant lines for soybeans, wheat, and corn. And then you're going to have another section where you're going to have them for bonds and notes. So basically, we're going to break the market up. I see you typing, Keith. Just go ahead. And we're going to create a dashboard. And what is that? That's going to allow us to do, and we're going to alarm the dashboard. Now, we're going to do 2 things with the dashboard. When you get a dual red or you get a dual green, it's going to give you an alert. But it's going to be, you need a little bit more than that. And so what we're going to do is you're going to get the alert on the dual reds only if price is below the 50. And you're going to get an alert on the dual greens if price is above the 50. So what you can do is you can have charts. Basically, if you want to be really aggressive. Okay, thank you, Keith. So if you you can have charts for 15 markets, and every time you hear an audible alert, now it's going to give you a visual alert. So if you have the dashboard up, it's going to say, dual quants on soybeans, and the price is above the 50. You bring up soybeans. If you like the way it's setting up, you can watch it for a while, and hopefully you're going to get a long trade. Remember, this isn't a signal to go long. It's just a signal that there's a potential long. It's setting up. You don't get these dual quants very often. And you can see when you do, they oftentimes lead to a trade. If the market isn't too choppy. Right here, it led to a trade. So that's what we're looking to do. You're going to have the power of quantitative analysis of multiple markets on a dashboard. And so that's really just about it. Now, I don't know who's in the room who doesn't own the software. If you own the software, you're going to get all this as free add-ons. If you don't own the software, the additional quant lines in the dashboard, we're going to split off in price. And tonight's the last night you got to have the opportunity to get it all in one big lump, because we've worked for months on the dashboard, and I've always made the promise that if you have the software, you get all the add-ons for free. Well, if you have the software, you will. The promise ends tonight. So if you don't own the software by tonight, then what we're going to do is we're going to split the core platform, the quant lines, and the dashboard into 3 separate purchases. So I just want to put that out there. There are not that many people in the room, but I just want the people to know who do own the software that you're going to get everything that we do, and that's always a promise, and that will stay. And I'm never going to pull that back. And I see you typing, Keith, and I see Sigma typing. Thank you, Sigma. And let me tell you, I know you're an owner. You're going to get all this stuff. I can't stand these companies that pop you every time they do an upgrade. I just don't like it, and I think it's I just find it very disquieting to me. I mean, my goal is to make everybody in the room profitable, and if I can do that with an upgrade, you're going to get that upgrade. I'm not going to charge you with a 2.0 version and tell you that the version you're trading is no good and charge you more money. It's not happening. So you're going to get the dashboard, and every quant line we get, you're always going to get these add-ons. So if there's nothing else, let me just put up our website for the few people that don't know it. And invite you into the room for a free trial. We're www.rightlinetrading.com. There you'll see a link to our daily net equity in the trading room. Now, Leo was off last week. It was his first vacation in 2 years. And the guy ran away, but he's coming back on Monday. And we'll update the website. We did really, really good last week. Thursday and Friday were perfect days. I had 2 winners and 0 losers on Thursday, 3 winners and 0 losers on Friday. On those 2 days alone, we made about $1,000. We're going to update the auto traders. We have links there. We have a link to our free trial. We have a link to a contact us page. You can email us at info@rightlinetrading.com or call us at 1-855-765-6681. Thank you. Listen, I appreciate that, and we're going to do everything we can to make you a profitable trader. I mean, it is my goal. not just to sell you software. You know, I don't hide under a rock. I'm right here on the front line every morning. I mean, I'm not just, I mean, my background. Thank you. Thank you, Sigma. And I'll just tell you this, you know, I don't tout it very often, but, you know, I have a PhD from Wharton. I mean, I have a doctorate, and you know, I don't swing it around like a club, but my predisposition is really is as an institutional player, and this has only just been a really recent jump for me. And you know, my thesis was really on the optimization of multivariable equations, and what I did was I looked at what I'm doing now, which is the optimization of market movement using as many variables as I could to try to define market movement, and that's what I'm doing in this commercial platform, because that is what the institutional guys do. Besides the fact that they just bang in a tremendous amount of contracts and create their own trend, they do multivariable analysis. And they determine the likely direction of the market, and that's the direction they pound in contracts. And this is really the only way a piece of software can work. A blue dot long and a red dot short is never going to work for you, because a piece of machinery is never going to get you exactly where you want to go. Although we do have auto traders which are updating with the quant lines, what I think are going to get you there. Thank you, Keith. Yeah, the NDT we've also given out. We lease it to people who don't own the software. But the NDT we've also, you know, we applied for a patent. Leo and I have a joint patent pending on it because it has trade configurations that nobody else has. All right, listen, everybody. It was a small crowd, but I really enjoyed talking to you all. You're all really nice guys, and I'm really on your side. I want you guys to make money, and I want you guys to be profitable. And anything I can do to help you, just let me know. Thank you guys. Keith, Sigma, Christian, all you guys. You know, I know how valuable your money is. I don't take it lightly. I really, really don't. I'm very, very, you know, I feel it's a burden, and I want to get you guys where you need to be. So listen, everyone, have a great evening. I'll see you tomorrow morning. Drag my butt out of bed. Leo will be here in the morning too. He's only got about 7,500 emails he's got to catch up on. And once he catches up on that, we're good to go. So let's have with the quant lines perfect, we should have our best month ever in June. So everyone have a great evening, and I'll see everybody tomorrow. Take care.